Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. Corey and Chad here, your host for this weekend show. On this weekend show, we are going to be focusing a bit more on the macro environment here, as we did have the inflation data out of the U.S. And quite frankly, markets, well, they continue to, I guess, broadly roll over at the start of the year, but they are still hanging up quite close to all-time highs, and I think we're all trying to figure out just what direction markets go next, whether it is a move much higher or maybe a trading range for the first little bit of the year. We are kicking off this show with Jesse Felder, founder and editor of the Felder Report. Now, Jesse, again, focused on the macro, focused on the CPI data. Headline and core came in at a 0.3% increase month over month. That was pretty much right at expectations. So, Jesse, what did you take away from that inflation data that we got early on this year?
Well, actually, I gotta correct you. They both came in hotter than expected. I think the expectation for CPI was 0.25% on core. It came in 0.31. So it did surprise to the upside. And I think when you look under the surface, things like sticky price CPI running 4.6% annualized for the month of December and for the 12 months ended in December. You have super core inflation, which is services. It's a term that the Fed uses for services CPI less housing, still running right around 5% and has curled higher in the last few months. So there's sign you have median CPI still running hot. I think this might be the first sign that, as many people have forecasted for at least a year now, that the easy part of the disinflation is over. The hard part, the most difficult part, is going to be bringing these numbers down from 3 down to 2, down to the Fed's target. It just seems to me that there are a lot of still underlying inflationary pressures, namely wages still running 5% year over year. A lot of that driven by union negotiations, which have negotiated, massive wage increases. So I think there are signs that the inflation battle isn't won yet. And it seems like that the stock market rally at the end of the year was really a mission accomplished moment where investors really had already, basically said that, inflation was back to the Fed's target or was going to inevitably. Now, I think that narrative is probably going to come into question this year as we see inflation remain a little stickier than most bullish would probably hope for.
Well, Jesse, speaking of the market or different outlets talking about mission accomplished, we've had a lot of people that have been pointing to Janet Yellen and other Fed heads taking a victory lap that they've got their proverbial soft landing. You've made the case to us in previous shows that you still see this year as the potential of having a stagflationary backdrop versus the soft landing narrative. Maybe dissect those 2 points of view and where you see the spread between them.
Well, I do think we are just now entering the time, and I had said many times when we spoke last year that recession was potentially a second half phenomenon. Obviously, that's been pushed out, and that was wrong. That was early, but I do still think that we are in this window of time where the interest rates, the lag effect of the rise in interest rates, is really starting to hit. And, you look at things like the inverted yield curve and the timing of those things when they start to have an impact on the economy is right about now. And so the delayed effect of monetary policy is just now hitting growth, I believe. And so the potential for nominal economic growth to decline is really significant. At the same time, if inflation remains relatively elevated, then you have, like you said, the potential for a stagflationary type of economy where real economic growth is poor and potentially recessionary. At the same time, inflation remains elevated. And that's really the opposite of a soft landing for the economy, right? A soft landing for the economy is inflation comes down to the Fed's target without creating a recession. So if you get inflation that does come down to the Fed's target and you still get, recessionary type of economy, that would be the opposite of a soft landing. And I think that's probably, far more likely than a soft landing in the economy.
So, Jesse, in terms of inflation moving through this year, do you think it just stays at somewhat current levels, or do you see another massive spike in inflation moving up to maybe 5% year over year numbers?
I think we are headed for another spike in inflation. I don't think it's going to happen this year. I do think we probably could see inflation remain above the Fed's target this year. It could bottom out somewhere closer to 3%, in terms of core inflation and things, and median, CPI and whatnot. But probably, another spike in inflation. If you look back at like the mid 70s, it was, several years between these spikes in inflation. And I think, I've used the analogy in the past that we're kind of in this era of, I think we're going to look back at what I would call central bank speed wobbles, where the Fed is kind of overreacting to shorter term dynamics, overcorrecting. And so we're going to raise interest rates. And then if they, do indeed lower them this year, even though inflation doesn't come back sustainably lower, they're opening the door to another rise in inflation. I think you could argue that they already have, with allowing the fastest loosening of financial conditions on record, which is what we saw in the fourth quarter, right? Even though inflation remains elevated, really opens the door to a much bigger and sustainable inflation problem. So like I said, I think we're still kind of seeing the effects of tightening of monetary policy on growth, which will also help to, keep inflation under wraps for a time. But the fact that the Fed is already, talking about, returning to a more dovish kind of stance, even while these underlying inflation dynamics are still significant, suggests to me that they're much more worried about protecting employment than they are preventing another spike in inflation, which means I think we'll probably end up with the latter.
Well, Jesse, just to that point, their dual-pronged nature, their dual mandate, they care about inflation, but they also care about the labor markets. So let's talk about the people in the economy here for a second. As far as the labor markets, it's continually pointed to as why we're not in a recession. Look how strong the jobs market is, even though almost every report has been revised down lower throughout the course of the year, and people are starting to recognize that they keep getting revised down. But generally, the jobs market has been stronger than most were predicting after such an aggressive rate hiking cycle. So how does that translate to the labor markets, and how does that translate to the health of the consumer? Because the people in the economy are the ones that are supposed to be supporting the business and the growth. How are the jobs market and how are the consumer doing?
Well, I mean, the jobs market, from all signs, remains, very tight, right? And that's why we have 5% wage growth. Unions are able to negotiate massive increases in pay and benefits. So I think part of that is demographics, right? You have the baby boomers, and we've talked about this before, the baby boomers retiring in droves, and the subsequent generations are not big enough to really make up the difference. And so we have a shrinking labor force relative to the overall population, which is a structurally inflationary dynamic that Charles Goodhart wrote about in his latest book, which is an absolute must read. So we have these kind of structural forces of inflation that I don't think enough people really appreciate. So the labor market is tough, is really tight for that respect from kind of a structural or secular level. But at the same time, we're seeing a lot of companies. We've seen Amazon and Google both announce significant layoffs this week. Before that, we had FedEx and Nike, and a lot of companies saying that waning demand is really putting a damper on their top line, and so they're having to start laying people off in response to kind of right size to the level of demand. That's not showing up in jobless claims, in new jobless claims or continuing claims or anything like that. So it did, in the last December unemployment report, show up in the household survey, which I think is interesting, right? I think it showed a loss of 600,000 jobs or something, and a massive disparity to the headline number. And those kind of disparities usually happen kind of late cycle because what classically happens is the headline numbers are revised lower, and then that's what we saw for many of the numbers for the second half of last year. So I do think we're at a very interesting time for the labor market where it still remains really tight, but there are a lot of cyclical forces right now that could result in rising unemployment over the next 6 months or so.
So, Jesse, if we carry this over to the markets, looking back, 2020, look, we all know what a crazy year that was with the COVID lockdowns and the crash in the markets and then recovery. But then 2021, S&P, I'm looking at a chart here, moved about 30% higher throughout that year. 2022, we all remember how tough that year was, where the S&P corrected about 30%. And then throughout last year, well, the S&P recovered all that. So it's been very, very volatile. Do you think there's any chance that this year is more of a digestion year where we get less volatility in the markets?
I don't. I think we're in this alternating period, and I think we're probably looking at another 2022 type of environment. If you look back at what drove the market last year, it was the Magnificent Seven stocks. What drove them? It was the hype over generative AI. This year, investors expect to see generative AI drive some significant revenue growth and earnings growth for these companies. So, it's time for, if that doesn't materialize, there's going to be a major disappointment. And I think that there aren't any signs that generative AI is driving any revenue growth just yet. I mean, Adobe has been a good example of this, where they've not been able to raise prices or charge for AI. They've just had to add it as a free feature to the products they're already selling. I think that's what we're seeing more commonly in the industry is if you want to add some form of generative AI to your product, people are grateful for it, but they're not gonna pay up for it. So I think, and the reason is there's all kinds of problems, right, with the hallucination and bad data and potential copyright issues with a lot of this stuff. It's really early on in the development of this, and so it really doesn't make sense yet for a lot of companies to pay for something that adds a lot of risk to their business and maybe not a lot of value add. So I think that this is the year where AI needs to either generate a bunch of top line growth to validate the rally of last year, or if it doesn't, there's going to be a reappraisal. And if the reality doesn't meet the hype with AI, a lot of these gains these companies have seen are going to evaporate.
Well, Jesse, there's no doubt about it that AI was the hot sector of 2023. When you look forward to 2024, the year we're in now, what are the sectors that jump out to you as potentially outperforming the rest of the pack?
Yeah, well, one question I like to ask myself regularly is what's the most hated sector in the market or the most hated stock in the market? And I think it's the natural resource companies right now. Nobody wants to own oil stocks. Nobody wants to own precious metals miners. And these kinds of natural resources companies the valuations are extraordinarily cheap. A lot of them trade single-digit PE ratios. At the same time, NASDAQ 100 trades 30 times and the S&P 500 is well over 20 times. It suggests to me that there's a real opportunity in these companies, especially if, as I suggested, inflation is going to remain relatively elevated. I think there are signs that the demand for energy is not going away. So many people, the bear case against energy stocks has been, well, demand for fossil fuels is going to peak and roll over. That's not the case. All the estimates of demand say it's going to hit new records this year and another new record in 2025. And there's supply issues, right? I mean, I know the Saudis are having to, OPEC Plus is having to, retain or hold on to a lot of these production cuts longer than people thought. But I think the real surprise for the energy markets is going to be the failing supply from U.S. producers, right? A lot of these shale regions are seeing a peak production and are seeing wells run out a lot quicker than many analysts anticipated. The Permian is kind of the last one where we've still seen tons of growth, but it looks like it could be not as sustainable as a lot of people hope. So if you have this dynamic of kind of impinged supplies at the same time, demand continuing to hit record highs it's very, very bullish for a super cycle in energy, which is something I've been talking about for 3-4 years now. There's also, the gold stocks too, where I think if we see inflation kind of maintain at an elevated pace, not even surge higher, but just fail to come back sustainably to the Fed's target, and the Fed is forced to taper quantitative tightening as they've been talking, or maybe even implement a few rate cuts, that's probably the most bullish scenario I could imagine for gold. And there's a lot of parallels to the 2018 to 2020 monetary cycle. The last time Powell pivoted, late 18, was, gold price bottomed and had a terrific run higher from about 1,300 an ounce to 2,000, just over 2,000. I think we're just entering a very similar monetary cycle for the gold price today.
So, Jesse, in terms of those energy stocks, we have seen, as you said, record production out of the U.S., but you see declining rates there. And that record energy production has come off of less rigs. So we actually heard that some of these companies are being more efficient. In all fairness, the energy stocks have still done fairly well, though. If we look at XLE, that's at least trading in a much higher range than it was over the last couple decades. And it's the gold stocks that really don't seem to be making any headway, unfortunately. What do you think changes that narrative then? Is it simply prices exploding higher, or does it translate into markets falling, or something else happening in the financial world?
Yeah, I think right now markets spent last year pricing in a return to the pre-COVID paradigm of disinflation and low interest rates and significant monetary accommodation, right? That's what I think stock market bulls and people buying the Magnificent Seven think we're going back to what worked from 2009 to 2020. What I think where there's a disconnect is I don't think there's a very good chance that we're going back to anything like that. I think we've had a paradigm shift, a sea change, call it whatever you want, in inflation, and that's going to really tie the hands of the Fed and make it very difficult for them to stimulate in the way that they did from 2009 to 2020. And we have these kind of secular inflation pressures. So what worked in that decade is not going to work in the post-pandemic decade. What's going to work in this post-pandemic decade is what worked from 2002 to 2011, which was by natural resources. And if you look at that bull market in oil prices and in gold price, the last major kind of super cycle in commodities, I think that's a really good parallel indication of what we're looking at for the rest of this decade is where we're going to see demand for a lot of these commodities surprise on the upside, and supplies are just really, really constrained simply because over the past decade there's been no investment in the supplies in these things. And so you have this supply demand dynamic. We've talked about this, I think, many times over the last year or two, where if you want a green revolution, you want all these things you're going to have such significant demand for commodities that if you're not investing heavily in production right now, the prices have to go to the moon in order to inspire that production. So I think I'm still a big believer in that we're in the early stages of a commodity supercycle. What gives me the most confidence right now about gold is a chart that I shared with you guys that shows the ratio of the HUI Gold Bugs Index, essentially gold miners index, to the gold price. And when you see this ratio spike, and that's the miners leading the gold price, it's usually a good sentiment signal that sentiment has become far too bullish towards gold. And we saw that in 2020, the first time gold tried to break out above 2,000. We saw it again in 2022 during that attempt at breaking out. What is so exciting to me about this ratio is testing the bottom of its range of the past decade, suggesting there is no interest in mining stocks, even though the gold price is now breaking out over 2,000. So to me, this suggests that there's still a lot of potential demand out there, that the gold price needs to go up another few $100s before you're going to see that type of embrace, that type of overly bullish sentiment that would be indicative of a trading top. that goes along with where we are in the monetary cycle, that if the Fed's going to start tapering QT, potentially, implementing rate cuts, it's very bullish for the gold price. And the fact that nobody is buying gold with this kind of very bullish monetary outlook ahead of it is extremely bullish from a sentiment contrarian standpoint.
Well, Jesse, just one follow-up on the sentiment. We talk about this all the time. I'd love to get your take on it as far as what will drive the generalists back into the sector when, in the backdrop, the Dow just hit a new all-time high in the fourth quarter of last year, and the S&P and the NASDAQ almost got to new all-time highs and eclipsed their July highs. When cryptocurrencies are ripping again, and look at the moves you've seen in Bitcoin and Ethereum and some of the crypto miners, when there's so many other sectors doing well, what brings generalists over to things like the energy stocks or the precious metal stocks? Because there's a lot of competition for them.
It's the same thing that drove it during that the previous monetary cycle from 2018 to 2020. It's people realizing that the Fed can't taper, the Fed has to cut interest rates, and they can't do what they need to do to effectively battle inflation. It's essentially realizing that, wait a second, disinflation isn't going to go back to that pre-pandemic paradigm. Things are different today, and if that's the case, and inflation's going to remain higher on a structural level, then I need to own things that protect me. And in a stagflationary environment, right, with not slowing nominal growth and elevated inflation, that's a terrible environment for owning general equities, right? That means you have a slowing revenue growth and rising costs is very, very damaging to profitability. And so I think that's the risk to a lot of these, the rest of the stock market, is that you see the slowing top line growth continue to slow. I mean, right, Apple's seen 4 quarters of negative sales growth for the first time in a decade plus. So if this continues and costs continue to rise, hurting profitability, it's going to really be a major disappointment to the soft landing bulls who've been buying the S&P and the NASDAQ 100. And they're going to realize, okay, if inflation's not coming back down, then I need to own things that are going to protect me in an era of structurally higher inflation. And the best way to do that is buy gold. That's what I think is going to bring the generalists back in, is an inflation epiphany.
All right, Jesse, we'll wrap it up here. I know a lot of our listeners are sure waiting for those generalists, for any new investors to come into the gold sector. But hey, maybe this is the year where that happens. Maybe everything just continues to move together in one kind of universal chart too. Who knows? We'll all see. But boy, oh boy, there will be a lot for us to talk about this year and try to make sense out of any market moves. Jesse, great chatting with you. Thanks for taking time on this weekend show. We'll chat with you next month. Have a great rest of your weekend.
Thanks, guys. You have a great weekend, too.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout. Providing unique reporting on markets and companies since 1990. This is the Corlin Economics Report.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And in the second half of this show, we are chatting with Marc Chandler, managing partner at Bannockburn Global Forex. And I'm glad we waited to record this segment until Friday, because there's a lot more for us to talk about now on Friday. Marc, I first want to start off with a recap of the inflation data. On Thursday, we had the CPI data that came in that was slightly higher than estimates. And then on Friday, the PPI data that came in that was slightly lower than estimates and showed again another decline month over month in PPI. I believe that's 3 months in a row. So, Marc, as we have these two inflation data points, and again, one came in higher than estimates, one came in lower than estimates, what's your takeaway from kind of the net impact or the net look at inflation in the U.S.?
Yeah, so first I'd say that the CPI is by far more important than the PPI, and partly because, of course, Federal Reserve targets consumer inflation, even though it does it through the personal consumption expenditure deflator. PPI is really about commodity prices. And it's interesting that you point out commodity prices are soft, falling for the third time month over month. But it's really the CPI that I think is the key. And the amazing thing to me is that despite, as you mentioned, the slightly firmer than expected CPI, the markets did not care. And by not caring, I mean that two things. One is that U.S. yields fell further. I have the 2-year note yield down about 20 basis points this week. And I'd say that after that CPI, and we've had some Fed officials like Cleveland Fed President Mester, who actually votes this year, even though she's going to retire in the middle of the year. She pushed against the view of a March rate cut, but the market still has the bit in its teeth and is running with it. I think we finish up this week with about an 80% chance of a 25 basis point rate cut in March. And my own guess is that it's still too early to be that confident. Of course, we're going to get more data before the March meeting, but at the end of the day, I think that the markets need something much more solid for it to really rethink about the March cut. And we could see that data next week. We go back to the real sector data from the inflation. But before we just leave the inflation, maybe we should mention about what people now call a super core. This is mentioned by Powell and other Fed officials. This is the core rate, which in the U.S. we exclude food and energy, and it excludes housing. That rose by 0.4%. You're not going to see it on the tables on the news wires. They don't track it like this. But the super core X housing up 0.4%. And that turns into a 3.9% year over year gain, essentially same as in November. And because Fed officials like Powell have cited it, and it's still so elevated, running roughly twice what their target is for the overall inflation, I think that it's a concern, and I think this is why I don't think the Fed's going to cut rates in March.
Well, Marc, just to that point, when you think about how the year started, it was all about the jobs number the first week. This last week was about CPI and PPI, the inflation. Next week, we got some numbers coming in for retail and for the housing. So we see how these numbers start to affect the consumer. And then we should start getting in the next couple of weeks some of the Q4 earnings report numbers coming in. So it's going to be interesting to see what economic data matters for this year. What do you think that the markets are going to key in on more? Because last year was all about jobs and inflation. Is that still the story for 2024? Or are some of these other metrics like manufacturing or retail or housing going to play more of a part, or consumer confidence going to play a part?
Yeah, I think if I had to say one thing that's going to be the touchstone, I kind of think it's going to be the elections. And I think we might have talked about this before, but typically, and by typically I mean 15 out of the last 17 presidential election years, the stock market has rallied. And those two exceptions were exceptions, but they were crisis years, like 2008. So I think that the markets just looking at what the market's done, and most people I talk to, they seem fairly confident about rising stock market. I'm less convinced, even though the S&P's 500 just made a new high today, a little bit above 4,800. I'm concerned that this is going to prove to be like a double top pattern in the S&P's, and we have to wash out some of these late longs, bring us back down to about 4,600 or so. That's about 200 points from what we've seen today.
Marc, so as we, I guess, move forward with this year, right, and as you said, it is an election year, so I know some people are considering that as well, but so far it seems like there's a lot of liquidity in the system. Look at the VIX. The VIX is still relatively low, and markets, even though they have shown some weakness to kick off the year, they're still hanging around right at near all-time highs. How much do we need to focus on liquidity in the market, and how much liquidity do you think is even on the sidelines?
Yeah, we know that a lot of people, right? That we've seen like record flows into the U.S. money markets, and I mentioned this off mic that I had spoke at a risk managers association meeting earlier this week, and one of the big talking points was how resilient the markets have been in the face of these escalating hotspots like in the Middle East, and also think about what's going on in Ukraine. I mean, the U.S. and Europe struggling to give Ukraine more aid and weapons, and Ukraine having difficulty recruiting more soldiers. And so Russia seems to be playing this game of attrition, and they've stepped up their attacks. And there's other little conflicts. I mean, I think that the Rand Corporation might have had an assessment of over 100 like modest conflicts taking place around the world right now. So it seems to me like the world's very in a dangerous position. I'm struck by on a Wednesday, the Financial Times had three articles that caught my eye, I should say. One is their claim that what we're going through now, is the most elevated global stress, geopolitical stress since the end of World War II. And then they also noted that last year was the warmest year on record. And then there was a third article that caught my eye, all on the same day, of course. And this was that the crypto and like fintech was fined by the U.S. more last year for the first time than the mainstream financial system for like lax compliance. And so I think we live in a dangerous world, but you won't notice that by looking at the capital markets, where the Nasdaq is up 3% this week. The Japanese stock market, the Nikkei, is at 30-year plus highs, up almost 7% year to date. So yeah, I think that it's hard to measure this kind of liquidity, but I do see a lot of money still on the sidelines. I'm just thinking about money markets. And short-term, those who didn't buy money markets, a lot of people bought bills directly from the Treasury. So I'm concerned that this is really a liquidity-driven market rather than a fundamentally driven market.
Marc, I think that's an interesting point. And really, all things considered, it's crazy that the markets are up as much as they are, not just U.S. markets, but many global markets. It's also crazy that oil is not up more. So it's crazy the markets are up, but that oil isn't, in the face of all this geopolitical tension, as well as just some of the different machinations from OPEC and the supply cuts and the supposed coming cuts. But one thing that's usually a gauge of volatility is the U.S. dollar, and over the last week, it's barely moved. It's hanging out around 102.15 here on Friday. What do you make of the fact that markets are healthy, the oil markets aren't, and the dollar is flat?
Yeah, the dollar is flat. We spent this whole week within the range that we set last Friday of the dollar index. I sort of think about this as a parallel would be, that old myth, King Midas, Greek mythology. Remember, he was being punished by the gods, and everything he touched turned to gold. I mean, who would want that? Doesn't it sound great? Until he tried to eat some food, drink some wine, and hug his daughter. And I think that that's our curse, really, is that there's a lot of important things that take place that just aren't reflected in the markets. And I think that partly it's how the markets really work. What is relevant to the markets right now is central bank policy, market positioning. And we saw, the dollar index fell from, say, on early November from 107 and fell to below 101. Call it a 6% move in the last 2 months of last year. And so I had anticipated a bounce, and we got that bounce, but we've really gone sideways this week. We really made the high last Friday a little bit above 103. I'm thinking that this correction after falling in November and December is not over. To me, I'm looking for another leg up in the dollar. And that, I think, could take us up to 103.5 to 104 area on the dollar index. If I'm wrong, which is always a possibility, of course, I think that it means that we have to go back down and test that 101 area.
So, Marc, again, talking about geopolitics, there are two wars ongoing, which the markets seem to largely ignore right now. However, on Friday, we did get some action in, you could say, gold, in some of the other areas, again, on the back of that inflation data, too, that reacted at least a little bit to the wars that are continuing here. Are markets now just so big, almost a beast on their own, that geopolitics, and we can include the election, they don't seem to have such a big impact, at least right now?
Yeah, I think so. I mean, I think that with gold, I mean, I'm not sure. I sort of would say that gold is sort of like caught in between the geopolitics, especially the Middle East, which should be good for gold, you'd imagine, and the drop in U.S. rates. As I mentioned, the 2-year note yield is in the U.S. off about 20 basis points this week. And holding everything else, constant, if you would tell me U.S. yields off 20 basis points, I'd be more bullish gold too. What strikes me, though, about what you say about the geopolitics is this weekend on the 13th, Taiwan has an election. It's seen to be a very important election, partly because, of course, this is the Taiwanese issue is key. China continues to at least aerial harass Taiwan. There's been a stepped up cyber attacks, and yet the Taiwanese stock market is flat this week. No real impact on Taiwanese stocks. And if anything, they've held up better than Korean stocks, which are off like 2%, and Chinese mainland stocks off about 1.33%. So I think, it's a sort of a bit of a enigma, a riddle about why how well the markets have been holding up, despite what seems to be a deterioration in geopolitics. I think that it's telling us that people who are voting with their pocketbook are not focused so much on geopolitics, that they don't see it really affecting the kind of drivers like interest rates or inflation, even though there could be some more sustained disruptions to supply chains.
Mark, just a quick follow-up on some of the Asian markets. While the Chinese markets had a rough go of it, in general, the Japanese markets, the Korean markets, the Philippine markets have all done pretty good. What do you make of the strength in the Asian markets? Is that something where Westerners are looking at some of these there's a lot of Asian emerging market funds you can buy, but are they looking at these economies and maybe ETFs and businesses within those economies as potentially having more upside than some of the economies in the West, or how do you read that?
Yeah, Chad, I kind of think that the Asian markets are really off to, leaving aside China and some of the small ones. But I'm looking at some pretty serious losses from not only what I call the Greater China, Hang Seng in Hong Kong, Chinese markets, the mainland stocks that trade in Hong Kong down 5%, but Taiwan off 2.3% year to date. So most of that took place in the first week of the year. Korea down 4.9%. I think I think it's really like people liquidating after last year's rally, looking for better levels to get back involved with. Taiwan and Korean exports have until very recently been weak, and of course they're dragged down by the weakness in China, who, by the way, earlier today came out with a decent trade number showing an increase in both exports and imports. But so I too am thinking about like how are we going to manage the portfolios this year, and I think that the dollar is still well overvalued. So even though I'm looking for a near-term dollar recovery, I think that these foreign currencies like Japan, the Eurozone, very cheap relative to the dollar on a fundamental basis. The problem, though, I think, is that we still are growing. It looks to me like the U.S. economy probably is growing around 2% in Q4, and this is still well above most of like say the U.S. rivals or other like large economies. And so I think this is what's I think people are preferring the U.S. stock market, I think, and Japan to everybody else.
So one big theme that we were talking about over the last almost 2 years now was that investors did have an alternative outside of the markets because of money market funds, higher yielding, safer instruments that money did rotate into as markets were correcting. But now that markets bounced back so strong last year, still holding around all-time highs, and it does seem like the buy the dip mentality is back. Marc, do you think there is an alternative for investors outside of the markets?
I think cash. I mean, you think about taking no risk, give your money to the U.S. government for 6 months, 5.2%, without taking much risk. You want to lock it in for a year, 4.6%. If we knew that we could lock in 5% until the middle of the year, that seems attractive to a lot of people still. So I think that a lot of money on the sidelines. I think stock market valuation, people are concerned. Typically, the stocks rally ahead of the earnings season, which you note is kicking off with the financial institutions this week and industrials beginning next week. So I think, I mean, that's what I've done too for the first time, I think, in years, putting more money into fixed income, just trying to lock some of these high yields in place for a bit, while I'm concerned that if the reason the Federal Reserve is going to be cutting interest rates and the Eurozone cutting interest rates is because the economies are weakening, I'm not sure that stocks are necessarily the best place to be in right away. So I'm trying to like bide my time, but I do think that the yields have basically cash is still paying.
Well, Mark, speaking of yields, a lot has been made recently, and I've seen probably 4 or 5 articles in the last 2 days about the yield curve potentially flattening in 2024 and what that may mean as far as economic contractions. Right now, it's still inverted. It's been inverted for a while. It's been inverted for more than a year, where the short term is got higher rates and yields than the longer term bonds. But if that does invert, do you think it necessarily means we're going to have that recession that everybody has now assumed is off the books and we've had the soft landing? Or do you think that it is important, as the yield curve does flatten in 2024? If that happens, is that a signal investors should be cautious of?
Yeah, Shad, I think that's a really good point you raised. I think many people think that an inverted yield curve is what tips us into recession. But when I look at the charts of it, it seems to me more likely, more common for what happened is when the curve is inverted. Yes, the economy is slowing, but when it steepens, that is when you get the economic crunch. And right now, the yield curve about minus 20 basis points. That's looking at the 2 to the 10. So the coupon part of the curve, the meat of it. We were at about 15 basis points last October. And so I think we need to see something like that. But I'm concerned that I know a lot of people have come around to the soft landing. And that's what scares me. I shouldn't say everybody, a lot of people were in the recession camp, and now they just like shifted sides. And I just think that what happens is sort of like in a parade, when you're out of step with the rest of the parade and you try to catch up. Sometimes you're still out of step, even when you try to catch up. And I think that's what the market is doing. And so for me, I think that the risks of a recession increase late this year, early next year. But right now, the economy does seem to have sufficient momentum where it's growing above what the Federal Reserve says is what they call trend growth, which is really the non-inflationary pace, which is about 1.8%.
Yeah, these recession calls do just keep on getting pushed back, but we will get a recession. The question is just when. So, Mark, in terms of next week, then, what data do we have to watch out for? Is there anything in the next couple weeks that could move markets or could actually set up another trend?
Yeah, so next week, I think that our attention turns back to the real sector for the U.S. We have to, as we look towards the second half of this month. Of course, this is when all the central banks really meet. Well, not all of them, but the Federal Reserve, the ECB, the Bank of Japan, the Bank of Canada. I think that this is sort of we're sort of in an interregnum period. Sort of the central banks have signaled more or less that they're done raising interest rates. They have not signaled that when they're going to cut rates, but it's clear that they are going to cut rates. That'll be the next move from the major central banks. And so I think that February, the next 6 weeks, say second half of January through February now, is sort of this in-between period where markets could be choppy. And then we get into March, I think that's when people are really making these bets about central bank rate cuts. And so that's when I think the volatility increases and this choppiness maybe gives way to a trend.
Okay, Mark, thank you for your insights. It's always great chatting with you to end the week, especially on a week like this week where inflation data and then some geopolitics perked up and got some markets moving. It is the end of the week, so now we need to wait until Monday to see if any of these moves will actually carry through, and who knows what news we're going to get geopolitics-wise over the weekend. Marc, thank you very much for your time. Everyone, if you want to keep up to date with Marc, check out his website, mark2market.com. And please go through our website, kereport.com, and podcast The KE Report to listen to all the daily editorials and company updates we recorded throughout the week. I hope you all have a great rest of your weekend.